All right, everyone. Welcome again to Hinshaw's Private Equity 2022 Market Forecast. We are very honored and privileged today to have an outstanding panel of three professionals in the PE space. And let me introduce each. From Huron Capital, we have Heather Medland. Heather leads Huron's business development and investment sourcing activities, including outreach to deal professionals such as business brokers, investment banks, attorneys, accountants, and consultants. Heather has over 20 years originating, structuring, and executing debt and equity transactions in the middle market. We have with us today Jeff McNamara. Jeff's a director at Duff & Phelps in the Industrials Division. Jeff is a member of Duff & Phelps Diversified Industrials M&A practice, where he specializes in executing mergers and acquisitions, private placements, and other corporate finance mandates. Jeff's clients include publicly traded, private equity sponsored, and family-owned businesses across a range of industries, including niche manufacturing, distribution, business services, and consumer products. And last but not least, Nick O'Brien, who is a managing director at Duff & Phelps in the Transaction Advisory Services. Nick is part of the Transaction Advisory practice and has over 11 years of industry and corporate finance experience, including several years of M&A transaction experience. Nick has advised both strategic and PE firms, as well as potential debtors, on transactions with an aggregate value of more than $2 billion. Thank you all for joining us for what should be a very timely and interesting discussion. To our audience, please, if you have any questions, send your questions in the Q&A box, and we will hopefully get to them at the end of the program and discuss them. Again, my name is Michael Weiss. I am one of the corporate partners in the commercial transaction group at Hinshaw & Culbertson, and I lead the PE practice subcommittee. On with the program. The first question we're going to direct with Heather, which is an obvious question, Heather, that everyone wants to know, and it's especially become another significant issue as of a week ago. What impact do you see COVID having going into 2022? And I guess we can add, after we wrote the question, especially the Omicron variant.
Yeah, a good question. And, I'll state the obvious. I certainly do not have the crystal ball here. This is, one person's opinion based on what we've seen. But, I think it's important to know where we've been this year, to know where we might be going next year. We have seen, and all of you can attest, an unprecedented amount of M&A activity. I don't know if you guys saw the Wall Street Journal article on Monday, but they said there was a record almost $1 trillion worth of deals in the US done with private equity firms. That's 2.5 times the volume in the same period last year, and more than double that of the previous peak in 2007. So sit with that. I think that states, for me anyway, I can't see that level of activity sort of happening again, even going into 2022. Regardless of what happens, it's hard for me to see that. But at the same time, I don't think that there's fundamentally or structurally anything that's going to change in our environment that might stop it. We still have lots of capital out there. We still have low interest rates driving great availability of debt, and lots of investor money flowing into the private equity coffers like ours, ready to be deployed into new transactions. I think in some ways it's a first half versus second half question, Mike. And from a COVID perspective, I think GDP and company growth and all that might be tempered, at least in the first quarter, given uncertainty with Omicron and all the variants that we keep seeing popping up. Vaccination rates are increasing though. But I think like consumer spend down is what they call it. Like there's, government money that had come in, people have excess savings, they're spending more money. So I do think we're going to see some growth in the first quarter. What I think are sort of what I would call wild cards that are mostly COVID impacted and somewhat not are inflation and interest rates, and they kind of go hand in hand, and we're going to talk about that later. The availability and the cost of labor, which has been an issue lately. And finally, supply chain challenges. And I think, pending what happens, my hope is that we see the labor market start to open up. I think we've already seen that a bit with vaccination rates going up. I think supply chain challenges are going to persist, and that might have a damper on activity in the first half of the year. I'm hopeful that it doesn't, though, and we see M&A activity continue like it's been. All the investment banks that I have spoken to say pitch activity is strong, maybe stronger than they thought it would be at this point in the year. So look, M&A has persisted despite COVID, Mike. And so, I don't see that changing dramatically, at least in the first half of next year.
Great. Jeff, anything you would add? Would you like to weigh in?
Yeah, I think Heather makes terrific points, and her comment around looking back historically to gain visibility in terms of what next year might have in store is helpful. I'm still impressed by how quickly the M&A market bounced back in 2020. Second half of 2020 was very strong coming into this year, and there were certain drivers of that. But the one driver that we have seen and continue to see, and Heather touched on this, is the availability of capital. And it's significant. When you look at the S&P 500 just as a proxy, those companies are sitting on over $3.5 trillion of cash. That has moved up meaningfully over the last few years. Private equity continues to be very active fundraising. I think the last figure I saw was dry powder of roughly 1.4 trillion. So that is a lot of capital. That's over 5 trillion of capital that groups are looking to deploy, both strategic acquirers, private equity investors, and interest rates continue to be very accommodating. So I think there are a number of tailwinds here that continue to be positive. Not all industries have rebounded similarly. Some bounced back quickly. Some were not even impacted by COVID, but others were. And so it is case by case, and we see that across our practice. But I think the outlook going into next year continues to be positive just because of these tailwinds that do exist. And you continue to have a number of sellers of businesses that are either at a retirement age or in the private equity world needing to get liquidity and return capital back to LPs. And we're also hearing a number of business owners that might not have been ready to retire, but over the last year and a half, might have just decided that now's the right time. COVID was challenging for a lot of business owners, and so you have a number of these factors that continue to drive a lot of activity. And so the outlook for next year, I think, continues to be pretty strong.
Great. Nick.
Yeah, I would just add that, looking back, I think COVID really made companies either reinvent themselves or re-look at themselves. And I think that is something that I think it's just going to continue into 2022, where you might see improvement in companies. And with the dry powder out there, I think it'll be one where the deal activity, companies are showing higher EBITDA, and now you have the dry capital to deploy and have quality companies that weathered that storm and are surviving this pandemic.
Next question, Jeff, I'd like to direct this one to you. Again, another topic that I think everybody wants to hear your collective input on, and Heather touched on this. What are your thoughts on the whole supply chain clog we hear in the media, daily, and what impact do you think that'll have on PE deals next year? Understanding that this doesn't affect every business out there, But in some ways, I guess it does affect every business out there. There is a supply chain for everything. What are your thoughts on that?
Yeah, it's a very topical question, and we're seeing it across a number of our projects, specifically engagements that I'm a part of, more on the industrial side, companies that are in the manufacturing world and dependent upon those supply chains for different types of parts and inputs. And it has been challenging. We've seen it across the board, whether it be not having line of sight into all of your raw materials and the ability to have as much on hand as you would typically like to have, having products that are part of your process getting held up through international shipping bottlenecks. The cost of shipping continues to be quite high, although we're hearing and seeing that it is starting to alleviate and come down, albeit still relatively high to where it was pre-COVID. So these are real challenges, and it has been difficult for businesses, I think, to navigate those dynamics. And it creates a cost pressure as well when you have the supply chain issue elevating up your costs and the ability to pass those on efficiently to your customers. And one thing that we've seen across a lot of our clients is that there does seem to be an ability to pass those costs on, and ultimately are getting borne by the end users and the consumers. But there's maybe a timing mismatch on when that can happen. You might not be able to pass those increases on as quickly as your costs are increasing. And so one of the challenges is managing those input costs. And as you think about selling a business or going through an M&A process, you always like to have good visibility, good line of sight in terms of your profitability and the trajectory of your company. And the supply chain issues create a real wrinkle in being able to do that. The other thing too is it's not just on costs, it's on your own revenue. We've seen a number of clients have projects pushed out, or different engagements that they're working on get pushed out because customers just aren't ready for it. Maybe they have their own bottleneck occurring and they're not ready to accept those products. And so it does have a large impact both on the revenue and the cost side. But businesses have been very nimble managing through this. It's remarkable how quickly those supply chains were able to navigate around some of the bottlenecks that existed. And I think hopefully that continues to subside as we move into next year, but at least for the time being, it continues to be a real issue.
Nick, any thoughts on supply chain?
Yeah, it's like Jeff mentioned, a very topical matter right now. I'm working on a quality earnings analysis currently just on a US-based consumer goods distributor. They design the goods in-house, have the goods manufactured overseas in China, and then sell in the US or in North America. The issue with this company is consumer demand is high, but the supply chain issues have resulted in the company essentially missing their EBITDA forecast by 15% for 2021, just because they can't get that inventory to sell. And luckily they realized this in Q2, so they've over-ordered for the rest of the year. So now that the inventory is finally coming in, because it's been stuck on waters for up to 8 weeks, they're actually be able to weather the storm for a few months. But some things that I learned just through the management team on this deal is that the government, the Chinese government, rations electricity and does controlled brownouts at the factories during the high season. It typically happens every year, but what's happening that hasn't happened before is that these controlled brownouts are now occurring in the off season. So China's doing these brownouts on a rotation basis at factories, where it basically shuts a factory down for 2 to 4 days a week. And I think that will also throw more strain on the supply chain. Another thing that I learned that this company has boots on the ground in China, and there is talks that there could be additional quarantine mandates in 2022. And I don't know if you know, but the quarantine mandates, when they put those in place, especially after the Chinese New Year, most of the laborers travel to their home provinces during the Chinese New Year. And if you put a quarantine mandate in after the Chinese New Year, they're not able to get back to those factories. So there's that potential risk that there could be even more supply chain constraints when laborers can't go back to the factories and get the manufacturing up and running. So I don't see this being a issue that's going to be resolved in the near future. And I think the companies just need to weather that storm and stock up on inventory at this point.
Yeah, Heather, I'd like to get some more input from you. I mean, it's yeah, again, no crystal ball, but these are challenging issues for, your portfolio companies and evaluating deals. How do you even, quantify some of these issues? They're really, really challenging and seem to be changing weekly.
Well, first off, I mean, we are primarily a services focused firm, but I will say, yes, manufacturing is a logical place where you'd see some of that supply chain challenge bear out in the financials. But I would also say it happens in services too. And, we install equipment, as in commercial HVAC equipment, as an example. And if that equipment isn't available when that project is needing to go, we can't do our job, and thus we can't get paid. So we're seeing record, pipeline activity and backlog, but the conversion rate is very much being impacted by project delays, supply chain challenges, and labor challenges. But what I will say is, when there are challenges, there are also opportunities, and private equity is notorious for being creative, innovative, and finding that next place to play. So I would say there's lots of opportunity in logistics services, for example, if trying to get product from the port to the home or to a business, there's lots of activity from an M&A perspective, trying to figure out who the winners and losers will be. Technology, as well, as you try and automate IoT in terms of manufacturing and automating plants, and outsource labor. Companies that focus on managing the labor for a warehouse, as an example, and trying to capture as much of that as possible to do it as efficiently as possible for the company. And then finally, education and training. We own human capital focused businesses. Most of our companies don't necessarily have a retention and program for employees, but education and training platforms are all the rage right now, particularly virtual. And so there's lots of activity there. So broadly speaking, yes, there are challenges and we need to address those, and we do. However, we're also seeing opportunities where maybe there wouldn't be any in spite of it.
I want to move over to another topic that's getting a lot of attention for the first time in, many, many years. Nick, I'd like to start with you. Inflation, which is, we've had so many years of no inflation issues or concerns, but everyone's talking about inflation in, consumers in the retail stores and businesses. Is this a real concern? And what impact do you see it on, PE activity going into next year?
Sure. Yeah. I think inflation is definitely hard to ignore, and definitely a concern that several companies need to take into consideration. So when we dive into the financials of a target company, there's two things we look for, which Jeff mentioned earlier. Can the company pass its increased costs from its vendors onto its customers? And then the second thing is, how quickly is the company's inventory turning? So to address the first point, if a company is able to pass costs on to customers with price increases, inflation is less of a concern. However, if they can't pass these costs on to customers, whether it be because they have pricing limits or pricing constraints within customer contracts or other stipulations, then you want to make sure, or you want to know if the company's actively trying to cut costs in other areas. Given the inflation, not only in inventory, but also labor, all of these factor into your margins. So it's something that our operational due diligence team has been helping our clients with, just to identify cost savings initiatives if once this inflation starts impacting companies, and then you can implement that after the purchase of the company. My second point on just how quickly is inventory turning. As with any company with rising inventory costs, it's just important to know if these cost increases are sitting in inventory. So when you're looking at the face of financials, if a company is appropriately recording inventory and capitalizing the variances, which a lot of times they're not, and inventory is only turning maybe 2 to 3 times a year, then those price increases are not yet flush to the P&L. So your margins won't really reflect that until you churn through that inventory that was with inflated prices. So it's just good to understand if margins may soon see a decline because the company has these rising inventory costs and have yet to be realized on the P&L, especially if it's lagging any price increases that you've implemented to your customers.
Yeah, Heather, any thoughts you have on inflation and how it's impacting potential deals and some of your portfolio companies?
Yeah, I mean, I think it's a timing issue. I think we keep talking about this in the near term. I think consumer price inflation is what we're really worried about. And with supply chain disruptions and rising rents and cost of living and food and all of that stuff, I don't really see that coming down in the near term. So it really comes down to what is the Fed going to do about it and how bad will it get before the supply chain loosens up, the labor market loosens up, and to Nick's point, the companies start, raising their prices, and you're starting to see on the business side price inflation. So I think it's a timing thing. I'm hopeful that in the second half, like the Fed is already taken its foot off the accelerator, and what we all don't want to have happen is rising interest rates, which may be the only solution if inflation continues. So, I mean, my hope it's not, but we all know what impact that has on leverage. We all know what impact that has on M&A as a result. And so that would be the one sort of concern that I would have. I mean, in terms of how we're dealing with it at the portfolio, it's exactly what Jeff and Nick have been saying in terms of passing along price increases and doing what we can from an efficiency standpoint to make sure that every labor dollar we're spending is actually turning into revenue or saving us money on the margin. And so that's just, that is private equity 101 in terms of value creation. It's just some of those priorities may be moving to the top of the list right now.
Gotcha. Jeff, your thoughts?
Yeah, I guess one last thing I would mention is that we hear a lot about the demand pull creating inflation. Consumers have more money to spend, and that's creating inflation. But what we're also seeing is a real cost push as well. And there's been some discussion around labor and how tight labor is in certain industries, and specifically in certain skill sets. Labor can be very tight, and those wages sometimes for a machinist or a welder, those wages, those hourly rates, it can be challenging if you're getting real cost pressure from the labor force to manage that effectively. And the risk or the downside is that many times a manufacturer or other business doesn't have an abundant number of options on refilling a potential position. So if you have a welder that you're paying an hourly rate to, and they're able to get a meaningfully higher rate from a competitor down the street, the ability to find that experienced person, even if you are able to increase your wages, the ability to now go and find another experienced welder is a real challenge. And businesses are seeing that. And we hear about the number of open positions, 10 million or so open positions across the country. But within specific skill sets, within the manufacturing world, it can be very difficult, especially if your facility is located in a small town. One of the other things that we've seen too is that the work from home environment has made it more challenging to retain talent as well, because now you can have competitors poaching your employees and willing to pay more. And what used to be the logistical complexity of having to move to another city or move somewhere to now go work at that new company, many of these folks can just be remote now. And so that's creating another dynamic in terms of a cost push in terms of being able to retain that talent because employers know in many instances, it will be very difficult to backfill and find replacements for some of those key folks.
Heather, turning to another topic, would like to start with you. The infrastructure bill has passed, and I guess just, government spending, the infrastructure bill, a possible spending bill, possible tax changes. How do you see that all of those factors impacting deals and underwriting going into 2022? It seems to kind of cut both ways. I mean, spending may spur, economic activity, yet, increased taxes may slow activity. So what are your thoughts?
Yeah, I think, again, this comes down to a timing issue. And, I think we were already seeing improvement in infrastructure spending going into the bill that was passed. And it has been on the rise of late. I mean, we're seeing it in our own portfolio. One of our sectors of focus is infrastructure and utility services, and we own a paving and road construction business in Arizona. So we're seeing it in real time there. And we're also seeing it in a company we have under LOI in the telecom services space. So this has been occurring. I think, in the short term, the impact will be positive. I mean, people foresee this growth coming, and there might be perceived lift in valuation for businesses that do focus on infrastructure. And as a result, those businesses may go to market with a great growth story. I think also from a real lift perspective in M&A activity, I think some of the issues we're talking about today, sort of tight capacity with manufacturing and labor, I think companies may be more apt to advance projects and in advance of sort of seeing some of this spending come and in advance of kind of rising cost environment. So I think we may actually see an actual near-term lift in spending and revenue as a result. But I think, look, we're not going to see the real, most meaningful impact of this bill for, at least 1.5 years, 2 years into 2023 from a revenue and earnings perspective. But I do think there's a short-term impact to be considered. From a tax perspective, look, I mean, we've been talking about this for, over a year now. I don't think we're going to see any meaningful changes in corporate or personal taxes anytime soon. So I think the impact will be more of a perceived what's to come concern, much like we saw in 2020, 2021 with business owners. I feel like it was a little bit of a, oh, shoot, this is coming, we should do something. And then it became clear it wasn't coming, but they were still selling for all the other reasons we talked about. So I think some of that tax will still be more perceived and ahead of what might come, but the actual impact is we're not going to see the tangible impact of that anytime soon, in my opinion.
Sounds good. Jeff, anything you would like to add to that? I know there's a lot of different thoughts out there.
Yeah, Heather made a really good point around the perceived tax impact. And at the outset of this year, there was a lot of momentum across our clients to get in front of a looming tax change. A number of those conversations have really subsided. And I think that's twofold. One is no one has a crystal ball what next year has in store. But also at the same time, I think many of our clients became aware that tax laws can be implemented and in some instances might even be retroactive. And so in terms of what that effective date might be. And so there seemed to have been in the second half of this year, a little bit of a lessening of importance around trying to get in front of those tax changes. I will still say that for all the mandates that we're working on right now that are trying to close by this year, all of those clients want their deal to close by 12/31. If you're that close to maybe being able to eliminate your risk of having it go into the next year, might as well get it done. but that doesn't seem to be a real core driver. On the other point too, in terms of some of the new spending that is coming out of Washington, it's hard to really pinpoint how that is going to impact any one particular business. We saw this on the last infrastructure bill that came out a handful of years ago through the Trump administration. And one of the challenges that you have is trying to identify when those dollars are actually going to benefit your business. And it's very difficult to do that in many sectors. So it provides a nice tailwind. You know, there are big dollars out there that are flowing into particular pockets of the economy. And if you're in one of those pockets, you have a tailwind, but very challenging to try and estimate what that's going to mean from a revenue perspective to your business.
Nick, any thoughts on?
Not on this topic. No, I think Heather and Jeff tackled this one pretty good.
All right, next topic. Jeff would like to go to you first, and this will also discuss and answer a lot of the questions coming in from our viewers. Let's talk about deal structure. A few things. Can these multiples last forever? It seems like we just don't know. But are all these different tailwinds and headwinds affecting the structure of deals going into 2022? More earnouts, different structures, lower multiples, those kind of issues. What are your thoughts in the actual transactional deal space?
Yeah, it's a great question. It's one that we get often from clients, especially those that are looking to explore a potential sale of their company. And no one has a crystal ball, like Heather mentioned at the outset of this. No one has a crystal ball what this means going into next year. But going back to the supply and demand dynamic around the scarcity of companies that come to market, especially if they're good companies, and the number of potential acquirers and the amount of capital that all those acquirers have continues to create somewhat of a supply-demand imbalance. And Heather at Huron would see this every day on deals that they're pursuing, in the competition that exists out there by having all of this capital chasing private investment opportunities. And private investment, private equity has been a very strong asset class over the last 10 to 20 years. It's continued to attract more capital. At the same time, as I pointed out, strategic acquirers continue to accumulate more and more cash. And so we're seeing that. And I think that will continue to create at least stability in terms of where valuation multiples are at. And there is concern around where interest rates are going and what that could mean going into next year and the year beyond that, because that does have an impact on what someone can pay, especially in the private equity world, where you are looking at it from a return perspective. And if you can't get as much leverage tomorrow as you could today, that does potentially impact how much you are willing to pay for a business. And so I think that is the one wild card out there. And one concern that we're hearing and discussing with clients is changes in the leverage market around rising interest rates and what that could mean. And the other point too, Mike, that you mentioned around structure, there hasn't been a real shift in terms of deal structure or anything that I think would be somewhat consistent across a lot of the deals that we're working on. It's more company specific. Is there something specific that you are trying to bridge a gap on between buyer and seller? And maybe an earnout is the ability to do that. Going back to supply chain challenges, and maybe some of the work that you are working on is getting pushed out to next year. You thought it was going to be revenue this year. You have those purchase orders in hand, but the customers don't need it. It's getting pushed. That might be an instance, if it's very meaningful, to maybe create an earnout around some of that pushed out work that's getting impacted by COVID and supply chain. But there's nothing really consistent across the board that seems to suggest that earnouts or other dynamics are getting structured into deals.
Yeah, and I would agree in my practice, given all the factors and issues going on, deal structures have generally remained the same and have been, very sort of deal specific, maybe industry specific, but, there has been no real radical shift. And part of that may have to deal with what Heather mentioned, just the amount of capital out there. And, on the buy side is just, so overwhelming. Maybe the buy side capital is just willing to take a little bit more risk. Nick, like to hear your thoughts if you have any input on this one.
I'd say the only thing I've seen recently on deals is that the process is getting dragged out a little more. So if they're not hitting their targets, and you can't get that earnout in the structuring, then essentially it's just delaying the process. I've seen that multiple times in the past few months where, like I said, the deal's just getting dragged out more than it was, and the closing is always getting pushed. So, that's what I've seen.
Heather, your thoughts, please.
It's a little bananas, candidly. I think, what's shocking to me is like we see these multiples go up, and I think we all had sticker shock maybe a year ago, but it is pretty interesting that, 16, 17, 18 times multiple kind of feels like the 10, 11, 12 times of a year ago, a little bit. And I think the reason for that is there's arbitrage still exists in our industry. And particularly because we're a buy and build focused shop is where we see it most. And while, we're swallowing hard as we see multiples go up for some of these tiny or even mid-sized add-ons, we still have to be honest with ourselves and say, but platforms are going for 2 to 3 turns above that. And if that dynamic continues to exist, I think returns are going to be there for us, and life will continue at potentially higher valuations. Now, I think it's very sector specific, and I do think that there are multiples being paid for companies that probably don't deserve it, but because the overheated residential HVAC market, people just want to put money there because they see opportunity. I wonder if that's going to catch up to us at some point, because I do think some of the multiples just don't match kind of the quality of the companies that we're seeing. But again, arbitrage still exists. So I think one of the great things about private equity and firms like ours is, we find opportunities, and because we are a sector focused firm, we can combat some of all the challenges Nick was talking about in terms of process, and Jeff in terms of speed. And we can kind of find those niches and spots and understand why a company is going for a high valuation or whether we think it's worth the discount, and we'll just walk away. From a structure standpoint, I'll make one comment. We are definitely seeing what Jeff talked about, and we're seeing it more on the add-on front because we acquire so many. We've closed, I think, 28 this year so far. So we are absolutely building in structure based on project delays or revenue not occurring in the fourth quarter, being pushed out to the first quarter. Now, we can understand and appreciate that because of what we're seeing in our own businesses, but I do think that structure is being used for sure.
Nick, would like to start. This will probably be our last question. Just a great discussion, panelists, on really all these topics. I mean, really, I think we're all learning a lot. Just a few minutes on industries and understanding that, that each of you are in just dealing with certain industries and not over industries, but what opportunities do you see for next year, and what industries do you see PEs in your space, your world, sort of avoiding?
Well, I mean, I think Heather or Jeff might be better to answer the actual specific industries, but some that I've seen a lot more, and I think private equity groups and others should consider in any industry, is get an assessment of the company's cybersecurity. The number of data breaches are at an all-time high, and it's not only impacting large companies like you hear in the news, but my clients' portfolio companies, they've been impacted. Recently, at one of my clients' platforms, I mean, $8 million EBITDA company, acquired it 6 months ago, had their systems hacked. The hackers shut down the company for 3 full weeks where, I mean, they couldn't process data, no emails, no phones, nothing. They're completely shut down. So luckily the insurance luckily the company had insurance, but they need to essentially settle with the hacker to get back up and running. So it's something that moving forward, no matter what industry, there's opportunities in availability, but where you should tread carefully is getting that additional assessment when you're looking at a company.
Yeah, no, the technology component is so important now in due diligence and underwriting, and it only keeps growing. Heather, I'll turn that question to you also.
Yeah, I mean, we spent some time talking about certain industries and opportunities that we're seeing on the services side specifically. I mean, we start with where are the tailwinds? I think there's infrastructure tailwinds, demographic tailwinds. There's and then one that I think hasn't maybe been mentioned as much as IoT. And I think the digitization of all industries is creating sort of opportunities for tech-enabled services businesses, software companies, technology in general, but then also on the services front and sort of automating. And so that's industrial technology and automation services is one of our areas of focus for that reason. And we're seeing a tremendous amount of uptick in that market. We don't spend a lot of time in technology and healthcare, so apologies to the audience question about multiples on healthcare services. I'm not going to be able to help you there, but tread carefully. I mean, retail, I feel the e-commerce bubble is there. How sustained it is going to be the big question. And if retail will ever come back as much as it, or as strongly as it did before COVID, but brick and mortar is kind of where I would tread carefully, and we don't focus there. So,
yeah. Jeff, turn it to you, and then we'll be down to our last 2 minutes for sort of, closing arguments, as we lawyers would say. But Jeff, go ahead.
Yeah, I guess just one thing to add, piggybacking off of Heather in her comments on the service side of the world. In manufacturing, or at least companies that are maybe a little bit more project-based, what's interesting is with each month that we distance ourselves from COVID, those companies are seeing improved performance. COVID and the impact to their business, where it was materially impacted, where work was slowed down, that's all moving quickly to the rearview mirror. And so for a number of these businesses that are maybe a little bit more cyclical, more project-based, that were impacted by COVID, as we move into next year, they're going to probably have pretty strong trailing 12-month performance. And the outlook is going to have a lot more visibility around it too, as those backlogs have continued to firm up across a lot of sectors. And so I think there has certainly been an emphasis over the last year for Tier A, high quality assets, and a number of companies that maybe were exploring a sale pre-COVID and we have been on the sidelines for the better part of approaching 2 years. A number of those businesses could re-enter the market next year because their financial profile has now recovered and the outlook has a lot more visibility.
I want to thank the panelists. I want to thank the viewers. I think we can go another hour, but everybody's got to get to work. Final, just, 1 or 2 sentence words of wisdom for everyone. Sum it all up in a sentence. No.
Competition is not going away. Figure out how you're going to play in an ongoing market that is as competitive, if not more, in the future. And the way we do it is through focus and consistency.
The other thing I would add too, for anyone that might be exploring a sale next year, and Nick touched on this, valuation multiples are high, but the amount of diligence that buyers are doing in order to substantiate and validate what they're willing to pay for a business is also very high.
Yes.
And so you want to make sure that you're very prepared and organized from a diligence perspective before going down that road, because there's a lot of poking and prodding that buyers are doing now.
This is not 2007.
Nick.
in that regard.
I mean, I would echo Jeff's comment exactly. The sell side QVs have grown, and I think it's just going to continue, and some might highly recommend because it's beneficial for all parties involved.
Thank you all. Thank you, everybody. And best wishes for the holidays. Talk to everyone soon.
Thanks, Mike. Thanks,
Okay,
Jeff and Nick.
Thanks.
thank you.
Thank you, everyone. Thank you, Henshaw.
Bye, guys.
Bye.